Let's take a look at the markets by going to the phone and talk with Brian Hoops of Midwest Market Solutions, and he's based in Springfield, Missouri, where I'm curious, what are the crop conditions like where you are there, Brian?
Well, things are improving. I think the last time that I was on, I talked about how some of the double crop soybeans are being planted right after the winter wheat harvest. We're getting planted in very dry dirt, but a lot of moisture has fallen since that time frame. So really going to improve not only the soybeans that are being planted, improve the health and kind of get them out of the ground, but it's also going to help the hay crop in that area. They certainly could use it after some very dry spring conditions.
Speaking of soybeans, let's take a look at our soybean prices this morning. And of course, everybody was closely focused on the crop condition report that came out yesterday in the progress report, and conditions were very good as expected. July soybeans this morning just up one tick at 8.74 3/4, and November new crop soybeans down 3/4 at 8.94 3/4. I saw where China is apparently dropping its import duties from neighboring countries in an effort to maybe alleviate any consequences from a shortage of supply coming from the U.S., although that's an interesting development because they normally don't buy any soybeans from those countries anyway. What do you think of that?
I think it's more political posturing. We've seen so much of that this last several months with negotiations between China and the United States. This is another part of the process. They're trying to send a message that they can and buy soybeans from other countries besides the United States. I think we all know that if this was November, that would be a completely different story. They want to buy our soybeans during our harvest when they're fresh and off the combine. And so they've got time to do this maneuvering and political posturing because it's only June, and this can continue for. So things will get much more serious once we get into our harvest season.
All right, let's look at the corn market. How's the corn doing today? Well, the corn is hanging on to gains. We have July corn 3.5 higher at 3.54 per bushel, and December 2 3/4 higher at 3.74 1/4 per bushel. Corn market firming up here today, Brian. Has it made a turn? Do you think short-term lows may be in?
I think the lows were probably put in last week. When we dropped the contracts to their lows a week ago on Tuesday, 360 on that December corn. I really look for more of a trading range, maybe 370 up to the 380 mark, kind of a sideways pattern going forward in here. If we could get above the highs that we had posted, the 380.5. So if we could print 381, 382, you should see some buy stops being in place. A lot of producers who are hedged are thinking that there should be significant upside potential. They're going to get out of those hedges if we can create some upside momentum and then try and resell a rally in the market. So that's a key area I think the market wants to watch going forward for the corn market. But otherwise, we're just going to be choppy sideways pattern. Okay,
in the wheat trade right now in Chicago, we have July down 5.5 at 471 1/4. Kansas City wheat, we have the July contract down 8.5. We're trading at 461 1/4. As we mentioned, the harvest pressure ramping up again this week. Minneapolis wheat on July is currently down 3.5 at 536, and the cotton market, we'll go ahead and go with December here, the new crop month. It's down 34 points at 84.58 cents per pound. We'll come back in a moment. We'll talk about our livestock trade with Brian Hoops when we come back. And we're back with Brian Hoops of Midwest Market Solutions in Springfield, Missouri. This time we're going to turn our sights over to the livestock trade. And on the cattle market, we've been chopping around here today, Brian, and both sides have unchanged so far today. We closed on a very weak note yesterday. In fact, the August contract by itself was limit down. We had the October only one tick away from that on the close yesterday. Today we have been higher, we've been lower. We've been higher, we've been lower. We have the August now trading at 102.68. It's decided to go to the lower side once again. It's down 22 cents, make it 27 lower now. And the October down 44 at 105.98 right now, at least for the time being. Feeder cattle trade, let's take a look over there on the August contract. It is now 1 point higher, or 1 tick higher rather, at 145.80 per hundredweight. And September down 30 at 146.20. So both sides have been changed simultaneously here in the feeder cattle market. The cattle on feed report that came out last Friday, of course, we had the on feed number coming out at 104% of a year ago. Placements were surprisingly high. The trade kind of unexpected that number, 100%. They were looking for 96, and the marketings came in at 105%. A little bit lower than expected, but pretty close. Brian, is that still kind of overshadowing this cattle market for the time being?
Yeah, for the most part, it's a drag on the cattle market. We tried to see a little bit of a bounce as stability came in the form of a stock market and show list numbers, which are down considerably this week compared to last week and even a year ago levels. But it's going to be hard to rally the cattle market too much. The cash trade is expected to be steady to lower this week as packers buying for a holiday shortened kill week next week. And you have a demand season that's starting to slow down after you get past that 4th of July holiday. Then demand usually wanes into the summer, and you have that one last holiday at Labor Day that gives you a little pop in the market. But other than that, it's a slow demand time frame. Plus, you've got all these trade issues going on with Mexico and the European Union, Canada, China, and we are very reliant this year on exporting beef and pork products. And if those demand levels start to fall a little bit because of trade disputes, we're going to have a real problem with too much supply on our hands.
I'm glad you brought that up about Labor Day. How much time lag is there from the time that the cattle leave the feedlot to the retail counter there? How far ahead would they be buying for that particular demand cycle for Labor Day?
Well, a lot of it depends on how much inventory they have in cold storage. The other part would depend upon what type of margins that they have to work with. Right now, they've got huge margins, so they want to kill as much as they can, put product in storage. So they may be trying to accumulate enough inventory with these huge demand base that they have and huge margins to work with to get us all the way through the rest of the summer and into Labor Day, so they don't have to pay up for it later on. So we may be filling our coffers full at the time being.
Ah, interesting. Now let's take a look at our lean hog trade, which has really been firming up today. And now you have your July contract up $1.57 at $79.65 per hundredweight. It had gotten as high as $80. It did ring the bell. It touched it and then backed away a little bit. We have August lean hogs now up $1.85 today. We're showing the last trade of $75.48. Now it's $1.88 higher. And October up $1.07 at $61.22. So triple-digit gains on the first 3 contract months on the lean hogs.